What's up, YouTube? Welcome back to another video. In this video, we're going to be talking about fair value gaps. I'm going to explain to you guys what a fair value gap is and to just kind of show you what they look like and how to use them when you're trading. Fair value gaps are a lot simpler than people make them seem. A fair value gap is basically this, guys. Here's a basic example of a fair value gap here. It is a 3 candlestick pattern. You're gonna see 1, 2, 3 candles, and inside of the middle candle here, there's basically going to be a gap inside of the market, right? And simply what that means is the wick of this last candle and the wick of this first candle are not touching, which means there is an imbalance here. There is an inefficiency at this price. What does that mean? This means here that there was so much buyers at this price point that sellers did not get a chance to get into this market right here. Okay, and that is very, very important. The reason why that's important because that shows momentum. All right, this is literally what I use to scalp when I'm trading NAS, when I'm trading NQ, when I'm trading ES, right? We look at these because we want to see who's in control of the market. So if you're seeing bullish gaps towards the upside, that means buyers are taking over the market and there's a lot of strong buyers, right? And usually what you can do here is, of course, you have to have a lot more confluence than just a fair value gap, right? You want to see maybe the market swept liquidity down here. All right, this is literally like a picture perfect setup when you have the market sweep liquidity prior and we move towards the upside, creating a fair value gap right here. What you can do is you can set a limit order at the gap, stop loss at the low here that covered the liquidity, and you can have a nice 1 to 2 target, or you can make a 1 to 3 target, whichever one is best for you. At least a 1 to 2, okay, minimum 1 to 2. And simply what you're gonna wait for is you're gonna wait for the market to come lower back into that gap to fill that pricing, to give that efficient pricing to the market. And the reason why the market likes to come back and fill these gaps is because the market wants to be as fair as possible. So for each buyer, there has to be a seller, and for each seller, there has to be a buyer. So in this price point right here, there was neither of that, right? It was only buyers. So in order for the market to be fair, the market loves to come back and fill these gaps here. And once we fill these gaps, the market will continue going back towards the upside because buyers are taking over this market. Okay, so that is the rule of thumb when it comes to fair value gaps. This is going to be like the best entry that you can take here, you know, when we're sweeping these lows and we're creating a bullish fair value gap after sweeping liquidity. That is a nice setup. Okay, now understand, guys, I don't want you guys just trading any fair value gap that you see. Okay, do not go ahead and just start trading any fair value gap. Make sure there's confluences, make sure there's liquidity, make sure you're following structure, make sure you have a nice bias with the fair value gap as confirmation for your entry. Okay, this is how we use this. The gaps are only confirmations for us to take entries, for us to see that buyers or sellers are into the market. So this is going to be the exact same thing, vice versa. So here's a bearish scenario of a bearish fair value gap. This is known as a bullish fair value gap. This is known as a bearish fair value gap. Okay, so in a bearish scenario, it's going to be the exact same thing, but flipped. Okay, you're going to have the market sweep highs, right? Sweep a point of liquidity, whether it's previous day highs, whether it's Asian highs, London highs, whatever the highs is, right? A good high for the market to sweep. Once the market sweeps those highs, you're going to have an impulsive move to the downside that creates a bearish fair value gap. Most of the time, the market likes to just come back and fill the gap and continue lower. All right, sometimes if this market is heavily bearish and we just have a lot of sellers here, the market will continue pushing lower and it will continue creating gaps towards the downside. Okay, now the thing is here, if you're seeing a series of gaps, and we're just gonna say here, boom, if you're seeing a series of gaps going to the downside, the first thing you need to understand is this is going to be the strongest gap. Okay, this is going to be the strongest gap, and 2, you might need to go to a higher time frame. You might need to scale to a higher time frame, because what will happen is these 3 gaps here could be one big fair value gap on like the 1 hour time frame or the 4 hour time frame that you could just draw out as just one large gap, instead of looking at 3 multiple gaps. But if you are on the lower time frames, the strongest gap is always going to be the one closest to the sweep of liquidity. Okay, so you might see the market come back, fill these gaps and not react, and then come to this gap here, which is the last gap before we took out, which is the last gap after we took out this liquidity here, and see this market drop like this. Okay, that is going to be your highest, strongest probability gap because it is the one that was closest to the sweep of liquidity, or to basically what the market did. Okay, 2 ways you can take entries here. First way you can take an entry here is you can take a limit order off of the gap. All right, you can take a straight limit order. This is when you have confidence that the market is bullish. You're in a bullish structure. You're in discounted pricing, right? This is a very, very, bias based trade where you are expecting the market to go higher because of previous confluences, right? You got to make sure that the fair value gap is not your only confluence here. Okay, make sure you sweep liquidity, make sure you have other confluences like structure and everything like that. All right, here's another entry possibility, and this is literally what I like to do here is I'll wait until the market gets into this gap. I'll wait for a reaction and for a break of this high right here, and I'll take my entry, and my stop loss will be underneath this middle candle. If this middle candle has a wick, my stop loss will be underneath that wick. All right, and that'll be a more confirmation trade for you to take, and I'll still target my 1 to 2, or like I said, 1 to 3. Usually I like to target a 1 to 2 when I'm taking these. These are quick, aggressive entries. I'm usually doing this on like the 5-minute time frame, so I don't need this market to go bonkers. Okay, I don't need this market to moon. I'm only looking for a quick 1 to 2, a quick flip on the account. So in this case right here, look at this 1 hour gap right here. We have this candle here, we have this middle candle here, and you can see we have this next candle in this 3 candle pattern, which creates this bullish gap. Inside of this 3 candle pattern on the 1 hour time frame, you see we have a 1 hour gap. Look what happens when the market gets into this 1 hour gap. We reject, and look at this move towards the upside, guys. Impulsive move towards the upside off of that gap right here. It's a 5-minute gap. Five-minute gap. Okay, and look what the market does here. Okay, and you can see we're creating 5-minute gap right here. Here's another 5-minute gap here. Okay, and this is why I say not the gaps alone. Okay, I'm showing you guys to understand this. It's not just the gaps alone. Okay, you do not want to be just trying to trade every single gap that you see. There is more that gets into this. What is our structure, guys? What is our momentum? Where is this market? If we're in a bullish market, we're in a bearish market. Look how the market has been moving. We've been going towards the upside. We've been sweeping lows, been going higher. Boom, we're sweeping lows. We've been going higher, right? This is a bullish market. This is a bullish trend. So my bias here is to take this market higher, especially since we have equal highs right here, okay? So when the market opens here on Tuesday, I want you to see we kind of push lower, and look what we push lower into. We push lower into a 1 hour gap here. When the market pushes into a 1 hour gap and it pushes into a higher time frame gap, look, I am not looking to take a 1 hour gap most of the time, guys. When the market pushes into a higher time frame gap, I am looking for a rejection. When I see the rejection here, I will zoom into the 5-minute and look for bullish fair value gaps. When we get into the lower time frame here, you can see the market pushes lower into this 1 hour gap right here, and look at the rejection on the 5-minute time frame, right? Look at this candle. We reject, we break this 5-minute bearish gap, which is an indication that buyers are stronger than sellers. When you see the market is invalidating, and this is basically what inversion means, all right? When you see the market is invalidating bearish gaps right here, when you see the market is invalidating bearish gaps, those are known as inversions. Okay, a lot of people trade those inversions, including me. This right here gives you the idea, and it just tells you that, hey, yes, the market was pushing lower, but look what we pushed lower into, a 1 hour fair value gap. And based off that 1 hour fair value gap, we got to push higher. Now, if this market was to invalidate this 1 hour gap, I would have expected us to continue lower to take out these Asian lows. Okay, but we did not invalidate We did not invalidate that 1 hour gap. We rejected off of it. And once we rejected off this gap, we invalidated this 5-minute gap. We invalidated this 5-minute gap. Now, the safest entry here, and you're probably wondering, okay, how do I take an entry off this? What do I do? You would be taking a bullish breakaway gap. Okay, and what does that mean? As soon as the market invalidates this last 5-minute gap, since that's the only thing holding us lower, right? This bearish 5-minute gap right here that we invalidated, that's cool. But this one is the one that we really want to get invalidated. Why? Because that gap here is the one that is nearest the invalidation of this high, and that'll create a BOS. So once I see the market invalidate this gap right here, I know for sure that we're going to create this BOS. Once we create this BOS, I know that we're going to go target these highs. Okay, and once we target those highs here, what's left? Look guys, we have a lot of gaps right here for the market to fill, and we have liquidity. So understand, when you see the market has like this price action that is bearish like this, and you see that we have so much inefficient pricing, the market likes to fill those gaps, guys. Use these gaps as targets and as entries. All right, so in this case right here, the best entry would have been waiting for this second gap. So we have this candle right here, we have this candle right here, and then we have this candle that closes up here. As soon as this candle closes, boom, take your entry. Stop loss here goes underneath this gap right here, right there. Boom. And then you could target a 1 to 2, which is right there. And I believe this market give you a 1 to 3 too, probably later in the day. Let me get out of replay mode real quick. Yep, later in the day here, if you were targeting a 1 to 3, the next day you would have got it. But this is why we only go for 1 to 2s, guys. 1 to 2s are literally a blessing. 1 to 2s will get hit majority every day. All right, and look what happens the next day here. This was before market open. This was before market open. Market sweeps, we go higher. Now I'm going to draw this to your attention. We're going to put this here, and this is why liquidity is important. Boom. Look what's happening, guys. The same thing here. The next day, this is Wednesday, right? These vertical lines represent New York Open. This is the time that you want to be looking for these fair value gaps. It's the time that you want to be in this market, because that is where the volatility comes in. All right. Now you're probably wondering, what do I do this day? What do I take this day? Okay. Look what you have here, guys. You have, boom, market opens right here. What does the market does as it opens? I'm sorry. What does the market does as it opens? We open, we immediately push to the upside, and look what we do. We take out liquidity. These equal highs that we're talking about, the market raised those highs, okay? And look what we do. We have this 5-minute gap right here. That 5-minute gap right here, I'm gonna delete this. We have this 5-minute gap right here. And then we have this 5-minute gap right here. After the market sweeps these equal highs, after we take out liquidity, the market immediately pushes towards the downside, and we invalidate both of these gaps. What does that tell you, guys? That tells you that we have sellers that are strong in this market. If you see the market sweeps liquidity and we invalidate fair value gaps that led us towards the liquidity, that is a nice confirmation entry to look for shorts. So how would you have taken shorts in this case right here? After these two inversions, like we took the last time, after these two inversions, guys, here's your trade, right? You have this strong candle. As soon as this candle closes, that's your entry. You can put your stop loss all the way right here, and you target your 1 to 2. There's a safer entry for you guys right there, right? You enter right here, boom, you target your 1 to 2, covering these 2 gaps right here. Stop loss goes above the wick. I'm sorry, guys, right there. Boom. That's the trade, okay? And look what happens. You can see this trade right here lines up perfectly with the 1 hour gap, right? This trade lines up perfectly with the 1 hour gap that was created the previous day before. The market goes lower, so you're taking a trade here. You're taking a bearish trade lower, targeting a 1 hour gap, and you see the market goes exactly there, rejects, and we push. You're already out of your trade. That is a nice and clean target. So this is just a simple example here of how you can use fair value gaps. I'm just kind of showing you guys this. I can show you guys so much more examples. We've only covered 2 days. We can get into the next couple days, but I'm gonna save that for another video. I don't want to make this video too long. I just want to give you guys this kind of background and just introducing you guys to the fair value gaps and how you can trade this. Okay, thank you for watching this video. If you have a specific question, or if you have something specific that you want me to cover in the next video, we're going to talk about liquidity as well in this series. Okay, so liquidity is going to be something that's very important as well. That's going to be the next thing we talk about after we cover inversions. Okay, so thank you guys for watching. Don't forget to follow me on Instagram, like and subscribe if you enjoyed the video. Peace out.